Hi, and welcome everybody. I'm Dr. Sam Roscoe. Today we are going to be talking about inventory management, trying to understand what is inventory, how do companies manage it effectively and not so effectively, and how do we get into situations where companies are holding excess inventory and some of the issues that that creates. So I'm just going to share my screen with you here, and we will go through and have a discussion on the role of inventory management is particularly in global supply chains, as well as um, within operations management. So when we're trying to understand what is inventory management, essentially inventory exists because of a mismatch between supply and demand. If a customer wanted a product, let's say, such as a felt pen, and I can make this felt pen instantaneously, so let's say I could 3D print it, for instance, right here, and I could develop this felt pen, there would be no time lag between supply and demand, basically meaning that I wouldn't need any inventory. I could make it and give it to my customer, and demand would be fulfilled. Now, what actually happens in operations, as well as particularly in global supply chains, which we can essentially understand as a series of linked operations. And that operation could be the focal firm's warehouse, the operation could be my supplier's manufacturing facility, an operation could be a raw materials extraction. All of those operations are essentially linked together in the supply chain. So when we're trying to understand this idea of a mismatch between supply and demand, what we have today is very complex and very global supply chains. And those supply chains tend to be located in Southeast Asia, for instance, Vietnam, Bangladesh, Indonesia, China as well. And then you have products that are made in various parts of the world, depending on the commodity of the product that you're making. And that you could also have, inputs, components crisscrossing all over the world to make a final product. Then that final product will be assembled and it will be moved to, let's say, to North America to be delivered to your customer. Okay, so basically, these long and complex supply chains create inventory. And when businesses have began to or began sort of back in the 70s and 80s to move all of their manufacturing facilities to low cost labor economies, China was a primary beneficiary of this big move of outsourcing and offshoring. What companies were primarily focused on was low labor costs, and they were often in search of finding low labor costs for their products. And they also found tax breaks, tax incentives, etc. But primarily, it was about keeping the cost of labor as low as possible. Now, what companies even today are very much focused on is what does it cost me per unit to make a particular item, and that could include all of your inputs, etc., to make that product. And then they might look at well as the transportation of that product to your customer. What a lot of businesses don't tend to think about, though, is the cost of carrying inventory as a result of long and global supply chains. And by that, I mean all of the cost of inventory that can accrue, including the opportunity cost of inventory. And I'm going to talk about that a little bit. So essentially, we have these long sort of supply lead times, anywhere between, let's take Adidas, for example. It takes Adidas anywhere between 9 to 12 months to make a new sneaker in Vietnam, put it on a container, put that container onto a container ship, and then ship it into the port of Vancouver, and then deliver that to one of their customers. So that's about a year lag between making a product and then actually getting it to a customer door. So that mismatch between supply and demand creates a year of inventory in various forms in my supply chain. That inventory can take the form of raw material inventory. It could also be work in progress inventory when the raw materials are being transformed, or it could be finished goods inventory when I've actually made the product and I put it in the box and I put it into a container. But we have that 12-month inventory holdings as a result of very long supply and very sort of immediate demand that's not being satisfied by that supply. So when we look at this idea is the rate of supply that I have coming in from my suppliers, and this could be all of my materials coming into a warehouse. The warehouse or the distribution center is essentially acting as an inventory holding facility. And then I have the rate of demand where I have my inventory going out. So you can see it is sort of the inventory builds up based on the amount of supply coming in as well as the amount of demand going out. Now, the reason why we hold inventory, well, there's lots of different factors. So primarily it's because of this time lag, this mismatch between supply and demand, but it's also because we have uncertainty in our demand. So we saw this during the pandemic. I do another video on this when I talk about inflation and interest rates during the pandemic. What we saw throughout the pandemic was huge market distortions for all different types of products, working from home, where we moved into electronics, and also where we stopped driving our cars, created a lot of different market distortions and created a lot of uncertainty in our supply and demand. Another reason why we hold inventory is to decouple or uncouple parts of the supply chain, and I'll explain that in a few minutes. We also want to make sure we have inventory on hand if there's a production stoppage. We want to avoid any sort of stock outs and to maintain our service levels. And we might want to buy excess inventory because we get bulk discounts when we do that. The other thing that we might want to do, and I talked again about this in my other video, is hedge against future price rises. So as we have high rates of inflation, we're going up all over the world back in 2021, 2022. Inflation is beginning to trend downwards now, but those inflationary price pressures were driving people to buy more because they knew the costs were going up. Now what we have is inflation, and inflation is causing companies to buy more because the cost of supplies are increasing because suppliers are raising their prices as a result of higher interest rates. Okay, so we find that companies are beginning to sort of purchase more in advance and bring that inventory into their warehouses to hold it because the cost of buying it, in their opinion, is cheaper than the cost of holding it. Okay, and we'll talk a little bit about some of the trade-offs there. I talked about this already, the different types of inventory that we can have. One of the interesting ones is this idea of pipeline inventory. So this is essentially all of that inventory. I talked about that 12 months of inventory from when I place an order, get the materials in, make the products, and ship it to our warehouse, depending on where it's coming from. I think the other thing to stress here is that service-based industries also have inventory. Okay, so if I look at a hotel, I look at a restaurant, they will have inventory in the form of, I don't know, food, they could have chairs, equipment, all sorts of things in the hotel, but the primary form of inventory in a service-based operation is people, is customers. And what you're trying to do in a service-based operation is move people through that process as efficiently or as high quality as possible, depending on your order winners and your service offering. Okay, so when we look at this sort of where is inventory held, we can understand it as single stage, two stage, or multi-stage inventory systems, just roughly. And I just want to give you a picture of how and where do we hold inventory. So if I was like a mom and pop shop and I was selling, let's say, Coca-Cola from my store here, essentially what I would do is I would have my suppliers bring the Coca-Cola into the back of my store. I would store it, and then as it's sold, I would put it onto my store shelves. So that in that instance, I have what is called the single stage inventory system. Now, if I sort of broaden that out and I look at who are the suppliers could be, let's say, Safeway, I don't know, Marks and Spencer's if you're in the UK. And essentially what we then have is we have suppliers delivering into, let's say, a Safeway central depot. And then that central depot would then have sort of a series of local distribution points, let's say in outside of Vancouver, but it could also be sort of northern British Columbia or all across Canada. And you have all of these sort of local distribution points. And at each point where you have a central depot as well as a distribution point, you're holding inventory in all of those areas. And by doing that, what you do is you begin to duplicate stock keeping units. So you have, let's say you could have 100 items of 100 cans of Coca-Cola in your central depot. But then what you end up doing is also having, let's say, 50 cans in your distribution center in Chilliwack, another 50 cans of Coca-Cola that are sitting in your other depot in Red Deer, Alberta, for instance. And then what ends up happening is your inventory begins to multiply across all of your depots because what you're trying to do is be responsive to demand and having inventory in the right place, but it creates additional costs. So this is where your buffer inventory is sort of sitting throughout your system. One of the interesting things that we saw during the pandemic, or before the pandemic, I should say, is businesses were very, very focused on reducing inventory. This was the whole concept of just-in-time delivery, of lean operations, lean manufacturing, where you wanted to have as minimal amounts of inventory as possible. Toyota talks about the stock should never touch the floor, so it's always moving from one station to the next and being worked on. They didn't really believe in the concept of buffer inventory. You would have just-in-time deliveries from suppliers onto the production line. And that system of just-in-time delivery, as well as lean, was adopted across all different types of industries. The grocery sector uses it, aerospace, automotive, of course, and through a variety of different industries. We're very focused on efficiency and reducing the cost of their operations by keeping inventory holding as low as possible. What we saw during the pandemic, though, because of all of these market distortions that I talked about, is that companies moved from a just-in-time system to what's called now a just-in-case system. So basically, that means we're going to hold inventory just in case we see a big market distortion. And we did see a lot of that inventory building going throughout 2021 into 2022 because companies were not really sure what people were going to buy, when we were going to come out of lockdown, et cetera, et cetera. And a lot of these companies began to sort of just hoard or even hold inventory, even though they didn't know they were going to sell it. And that inventory is just now beginning to be sold off, usually at a discount rate in order to move it off of the company books. So there's also this idea of a multi-stage inventory system where suppliers might deliver into, let's say, into a production line, into the back of a warehouse or a production line. And then we would go into the first stage where that inventory, let's say it's an aluminum coil, might be stamped into a door panel. That then moves to the next station, to stage 2, and that is then, let's say it's pressed and forged into a complete door panel, and then finally you go into stage 3 where it's painted. And then at each stage, what you're creating there is this work in progress inventory until finally you have a complete car, and you created again finished goods stock, which is a completed car, which is essentially inventory itself. And that inventory can sit on the lot of a car sales lot. And essentially, when we're driving by all of these car sales companies, and essentially what you're seeing there is inventory, is finished goods inventory that's sitting on the company books until it is sold. Now, when we try to understand like the cost of inventory, we have to understand that inventory costs take a variety of forms. And I'm going to talk on that in a little bit. And first of all, I just want to understand this concept of how does inventory help to decouple points in the supply chain? So this is an example here where the customer order can influence where inventory is held and how different business models respond using inventory holding. One of the models that a lot of businesses used to use, and a lot of businesses still do, and we take Adidas or Nike or Puma, for instance, a lot of these companies will still come up and design a new shoe. They will then make millions of these shoes, and then they will move it to, let's say, the North American market. They will then try to, or hope that all of these shoes will be sold. And they are managing to do that because they have very good marketing campaigns. They work with athletes and with rappers, for instance, in order to sell that product. So they're using this idea of making to stock. When you're making to stock, essentially what you're doing is you're having a lot of finished goods inventory that is sitting in warehouses waiting to be sold. Other companies are looking at this assemble to order type of idea, where you basically make let's say a Tesla is made until it is semi-finished, it's almost done. The customer order comes in, the customer can pick a range of different paints, red, blue, black, from a series of sort of 10 different choices. They can also choose their interior, then they can mix and match those. The customers are willing to pay more because they feel like they have a unique car. So you get this idea of sort of increasing the value of the thing that you're selling, increasing your value proposition. Now, the idea here then is that we make a product until it's almost finished, and then we get the customer order, and then we will customize it with paint and with the interior, and then we will deliver that quite quickly to the customer in order to fulfill that sales order. So essentially what you do is you have a very sort of lean and efficient supply chain up until the customer order comes in, and then you deliver out that finished product using a very flexible and agile supply chain response. Finally, you have what's called make to order. The idea there is, like, take a jeweler, for instance, where you have all of the raw materials. The customer comes in and designs the ring exactly how they want it, and then the jeweler will make that ring and then we'll ship it out. In a make to order environment, you have very low or none finished goods stock, but what you have is a lot of raw materials or sort of component type, semi-component type materials. Okay, so some of the main costs that come into play when we're looking at an inventory system, and why am I making such a big deal about inventory, is when we look at this disconnect between supply and demand, and let's say it is 12 months from the time that you raise, you come up with a new concept, you prototype it, you give it to a supplier, they find the space to make it, ship it to you and everything. If we have this big lag between supply and demand, and we have all of this inventory, work in progress, raw material inventory, finished goods inventory, we have costs. And often those costs are not accounted for. What companies account for is the cost to make the product. They will account for their warehousing costs. Maybe the transportation costs will be covered. They might account for the overheads of running a warehouse or a distribution center, etc. But in some instances, what's not captured is sort of the depletion of inventory, and that could be through obsolescence, but also the cost of lost sales is often not, or is very difficult to capture. If I have a year-long supply chain and I'm Adidas or Nike or Puma, and it takes me a year to create a new product and bring it to market, basically that means if there's any change in customer trends or my marketing campaigns are not successful, then basically what that means is that I will get stuck with a lot of stock that I cannot sell. And what these companies will do is they will then have to discount that product, usually 50%, 75% on the dollar, in order to move it. Okay, so you take an immediate hit to your bottom line as a result of it being unresponsive to demand. So the cost of lost sales is often not captured when we're looking at inventory holding. The other thing that companies don't capture is the opportunity costs for tying up working capital in that inventory. So working capital is sort of the grease in the wheels of global supply chains. I need cash and I need liquidity in order to pay my workers, to pay for materials, and to pay my suppliers. If I don't have working capital, then my business can basically ground to a halt, or I have to go to the bank and get additional loans. Now we're in a situation where interest rates are at 5 to 5.5%, depending on what country you're in. That means that the cost of getting a loan from the bank has gone from 0.25% back in the pandemic to 5.5% now. So the cost of capital has exploded. And that means that it becomes more and more costly for me as a business to hold inventory because my working capital is sunk into that inventory. I have this opportunity cost that I've lost. That cash could be used somewhere else. That cash could be used in, I don't know, starting up a new business venture. It could be used in launching a new product. It could be used in paying for an additional marketing campaign. But I can't do that because all my working capital is sunk into these products. And again, when I have long and complex global supply chains, the more inventory that I have to hold, the more working capital that is tied up into that inventory. And that creates all of these additional costs that are often not captured by businesses. And that begins to raise this question of having such a focus on cost-efficient supply chains and having such a focus on keeping our cost base as low as possible. What we miss out on there is how we can, if we had shorter, more compact supply chains, less complex supply chains, with suppliers that were located closer to major centers of demand, we could be more responsive to demand, and we would also shrink the length of our pipeline and our supply chain, so we would hold less inventory. So we would have two benefits. We wouldn't have the lost sales that come from long and complex supply chains, and we wouldn't have all that working capital tied up in our inventory within our pipeline. All right. So this is where we get into all of these issues. Companies will overbuy, like I said. When you have inflation, companies were overbuying. You also get overbuying when there is capacity constraints on suppliers, which we saw during the pandemic when operations were shutting down. or workers couldn't come to work, or we had to do social distancing. There was all of these capacity constraints, so prices began to rise. Companies had to pay more to get the supplies that they would normally be used to, and that had inflationary pressures. As companies, as procurement managers knew that prices were rising, they bought more. And that led to this idea of overbuying and then having to sell products at a discount. The other thing that we have to think about is looking at reducing our stock at the financial year end. And essentially what that means is if I'm Adidas, I've ordered all this product now that I can't sell because, I don't know, one of my wrappers is gone and got into trouble. That basically means that I've dropped them on my brand, but nobody wants to buy my shoes anymore. Essentially, then I have all of this stock that I can't sell, but it's my financial year end and I need to get rid of it. I have to shift it off of my books, so I sell it at a significant discount. Okay, and that creates, again, a huge amount of cost for my business. And then you also have overproduction. Again, when companies are targeting the amount of products that they make, and they're incentivizing their managers to make, let's say, 1,000 cars a day, managers will hit that target and they'll try to exceed it, but it doesn't necessarily mean that that stock is going to be sold. So that creates additional inventory as well. Okay, so I'm just going to talk about quickly about the topics of flow time and throughput rate, and then we'll wrap it up there. So when we're trying to understand this idea of moving inventory through a process, we have this concept of what's called the throughput rate or the flow rate through my operation. And basically, this is the idea of Little's law. And what Little's law talks about is that the throughput is the rate at which sales to my end consumers occur. So basically, it means that the amount of inventory that I'm holding is to do with the flow time of my process. That could be my supply chain, but it could also be an operations process. And then the time it takes for that inventory to move through that particular process. Okay, so just to give you an example here, we have the inputs, let's just say let's say semi-finished products coming onto a production line. Within that actual operation, you have your flow time of your operation. That is where you have this work in progress inventory that is being worked on. And then coming out of that, you have this average throughput rate where products are basically being made. And your throughput rate refers to how many cars you make per hour or per day or per minute, whatever it is. And the throughput rate is the amount of units that you make in a particular period of time. Okay, and that's what your throughput rate is. So your average inventory is happening in the operation. Throughput is when it's actually turned into a product and comes out the other side. And then the flow time is how long it takes to go through the process. So if we just take this as an example, you can see here that my throughput rate in this example is I can make 1 car per minute. But that is when they come off the production line. But within the process itself, I have 900 cars that are also being transformed into a finished vehicle. So the flow time basically means that I have 900 cars. It takes me a minute per car to come off. And that basically means that I have these 900 minutes of flow time. Okay, so my inventory here is my throughput rate times my flow time. Just another example, and that's essentially Little's law. Just another example of this concept is if I'm in a hospital, I have 300 people who are waiting for an organ transplant. I say on average, patients wait on the organ transplant list for 3 years. I assume that no patients will die during the wait, ideally. And then that makes me try to calculate how many transplants are performed a year. So basically what I understand is that my inventory is those 300 people that are waiting. My flow time is 3 years from the time I register on the list till I get my transplant. And my throughput rate would then be 100 patients per year. So I'm processing, or I have a flow rate of 100 patients per year through my operation. Similarly, we can work back. We can say on average, there's 300 people waiting for an organ transplant. And then I know that I perform 100 transplants per year. I assume again that no patients ideally die. And basically that means how long do the patients stay on the list? And what we find out is that it would be 3 years that they're waiting on the list. Okay, so we're just going to stop there. In my next video, I'll be explaining the concept of economic order quantities, and we'll be talking a little bit about ABC analysis as well. So thank you, everybody. Hopefully that was useful, and we will leave it there.